So I go back to what I write at the bottom of every honest truth, that there's an asset allocation statement. I'll tell you what I do. So I look at my monthly expenditures and I keep between 24 months to 36 months of what I need to spend every month into what I call the safe bucket, the safe money. And I don't think banks, in my view, are particularly safe. So I keep some money, of course, in banks because we all have bank accounts. But I consider a liquid fund, in this specifically my case, I put money in the quantum liquid fund as my safety money. Because the risk of your money being in a bank and the government suddenly telling you, well, we've just taken over this bank and the FDs are frozen for the next 6 months or 6 weeks is pretty high these days. Whereas in a liquid fund, well, it doesn't happen because you give a liquid fund the money, you give quantum liquid fund money, it takes that money, it buys government securities with it. It doesn't buy bonds issued by private companies. It only buys bonds issued by the government or by government-owned companies. So it puts money in that, and then when you want it, it sells that and gives it back to you. So there's a T+1 or T+2 time process to get your money back, but then it's there, so it's there. So I keep my 2 years or 3 years expenditure money in that. And the rest I've been splitting primarily 80-20. So 80% in equity and 20% in gold. And then the 80% equity that I have has been, in general, over 3 quantum mutual funds. So I used to say, and I have spoken about this at many Paths to Profits, that 80 to 90% of the money that I have in equity mutual funds is in the long-term value fund, because I'm a value investor. And the rest of it I kept in the quantum equity fund of funds. When I tell investors you all should do the reverse, out of that big equity pile of 80, you should keep a little bit of that in quantum long-term equity fund and keep a lot more in the quantum equity fund of funds, which invest in the stock market based upon how other fund managers pick their stocks. So in that you may have a growth or momentum or multi-cap or large cap and small cap and mid cap, and there's a whole basket. So by getting that quantum equity fund of funds, you've got an exposure to 6 of the 200, 300, 400 equity mutual funds out there, which quantum has studied, researched, and then picked the best that they think work for a portfolio. So you get that exposure. And then the quantum long-term value fund is a specific style of investment, which is a value style of investment, which honestly hasn't worked very well for the last 15, 16 months. And there is an honest truth on that also. So that's what I would do. I would just keep 2 to 3 years money in liquid funds, and I would keep 80% of the balance in equity funds and 20% of the balance in a gold fund. And that would be my allocation. And the reason I've got the 24 to 36 months is that in moments like this, when I think the markets are attractive, I'm willing to take a risk and I'm willing to take some of that safe money away from the quantum liquid fund and move it into the equity product. Because I think the rates of return, the risk-return ratio is very much in my favor for the next couple of years if I make that investment.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.